Well, good afternoon, investors. Welcome to our September 10th, 2024 edition of Bull Sessions. My name is Mark Robertson, and I'm joined here by my gracious investor of many years and magical math, Ken Pavola.
Thank you, sir.
I cut down on the adjectives a little bit there, just to
I
make sure.
appreciate that. Okay, thank you.
And we're also joined by our special guests, Kim Butcher and Matt Spielman.
Kim Butcher.
And Matt is also joining us.
I'm here. Hi, everybody.
Is it 70 degrees in Houston, Matt? Or
It is 85. So yeah,
that's not bad.
Yeah, cool. We've got a tropical storm to the south that we're apologizing, Louisiana, but escorting on by.
Cool.
Yeah, more water's going to get dumped on there.
Well, it sounds like Herb is sending good weather in our direction, and things are looking up for us. We are supposed to be in the mid 80s by the end of this week, so we do look forward to that. All right, so let's go ahead and get underway. We're going to dedicate a large portion of the session to review of the Buttonwood Bulls portfolio, that demonstration we started earlier this year that will include raking Thermo Fisher over the coals, and great company, but it's going to be one that we're going to debate a little bit about whether or not another company might serve the portfolio better. We'll continue our discussion of shopping amongst the Sweet 16. And Ken, what are your expectations for our session today?
Well, I'm not sure what that means, but I'd like us to end up with some alterations to the portfolio, which demonstrate how I think a good club should be operating. We're trying to put together a club portfolio that is not static. It's most club portfolios should remain dynamic, especially at the beginning when you've added a lot of stuff all at once and you're trying to figure out a way to make the portfolio better. Mr. Nicholson always said that was the primary reason why you sold something. You sell it to make the portfolio better, not usually because it's a terrible stock, but you usually make pretty good decisions on what you buy. But if you can find something much better, then replacing it is a good idea.
Yeah, no, I think that's an extremely important point, because we don't buy that many terrible stocks, at least not on purpose. And you're going to have to deal with that question from time to time. So let's go ahead and roll towards that objective. Here is our weekly salute to Portillo's. They are not yet a sponsor of this session, although they should be. And Matt shared the picture on the left. That apparently was a book that was on sale yesterday at Kindle. It's just a one-day thing, right, Matt?
Yeah.
So I forgot to get it. I actually was going to go grab it, but price probably went back up already. But it's apparently the legacy of the Portillos from the cart on the streets of the Chicago area to what they have become today. And again, company that seems to be doing fairly well. And again, thanks to all of you who either bought shares or hot dogs recently and drove that price back up a little bit closer to my buy point on the lower right.
Mark, happy days. It's still $2.99 today, so
it is.
No sponsorship by Amazon either, but there it is.
Okay. I might grab
Mark,
it.
I want you to watch in your mail, Mark. What's coming is a large brown envelope, and it has some magazine pages in it. I know magazines are very outdated, but I couldn't figure out a way to get a screen capture of this article in one of the most recent gourmet magazines, Bon Appetit magazines, excuse me.
Okay.
And the headline on the cover is "The Best Chicago Hot Dogs."
Oh no.
And I opened it up, and I tore out all the pages because it lists 10 of them. And nowhere on the list does Portillo's reside. So I'm going to send you what they think are the best 10 Chicago hot dogs, and
All
then
right.
I'm going to ask you to give me your honest opinion of their choices, at some
All
point
right.
moving into the future, okay?
Can I
But
collaborate with Kevin Glogli on this, or?
sure, you can if you'd like. I tried to make photocopies of them, but the printing is done over pictures, and the pictures are kind of dark. And when you do a photocopy, even if you lighten it up, you can't really read the printing very well. So I'm sending you the original magazine pages. I
Ooh.
know I'm a dinosaur, but I get lots of magazines, and I love just sitting
All
in the
right.
an easy chair reading a magazine. So,
We'll dig in, and I can be a dinosaur for a while and actually do that.
okay, great.
All right, here's our boilerplate disclaimer. No investment recommendation whatsoever is intended. This is entirely an educational demonstration that is intended to take what we have learned over 8 decades of following these methods and philosophies, specifically with respect to the discovery and analysis of opportunities. And so we will be giving our opinions about those specific processes and analytical techniques or methods. That's what we're here to do and share. And quite frankly, the Better Investing National Association of Investors / Manifest Investing community is all about helping your friends be better investors, and that's what this is all about. So please do your own homework and perform your own analysis of any potential opportunity before you hit the buy button on your phone, on your iPhone, whatever color it is. If we own something, we'll try to remember to disclose it, and we trust that you are smart enough to figure this stuff out. If you'd like copies of the slides, and there's actually going to be some pretty decent slides with respect to the Buttonwood portfolio in this presentation that might help with some considerations of potential best practices for investment clubs. So if you'd like copies of the slides, or if you have suggestions for future topics, our 2 email addresses are down there at the bottom of the page. Anything else, Ken?
No, I think that we're in good shape, Mark.
Quick look at the market. A week ago, that kind of lighter green line on the far right, which is the quarterly price according to the condition of the market, according to the value line arithmetic average, it was actually slightly above that blue trend line. So that September has been cruel so far, and we all know that stocks do not go from point A to point B in a straight line. They fluctuate, and it has fluctuated down. But in general, the average forecast out there is, call it 9% for the average stock. What would you like to highlight, Ken? Anything?
No, I like this graphic. I've asked that we can maybe occasionally show the graphic with the dates all uniform so you can compare equal amounts of time on some of these, but it's basically telling the story pretty well, I think.
Okay. You want to lock in that MIPAR. That MIPAR stands for the median, actually Manifest Investing median projected annual return. We cover about 2,700 companies at Manifest. The median / air quotes average return for a stock is 9%. You want to just keep that number in mind when we turn to the Buttonwood portfolio. All right, just a couple of quick snippets before we get underway. I had missed this one, but Barry reminded fairly recently that, we hear so much about the Magnificent Seven and how dominant it has been. And Barry's basically saying, not anymore. This is just this year. It's year to date. We'll take a look at a longer span here in a second. But can you actually confess that you knew this already?
Yeah, and I wish that I could remember the gentleman who's the senior analyst on CNBC who appears on a number of different programs in short 3 or 4 minute segments. I can't remember his name, and maybe somebody in the audience can help me out with that name. But he made this point about a week and a half ago that in his opinion, the market was already beginning to broaden. And he used this fact as an indicator of the fact that not only were the total indexes reaching new highs, or approaching new highs, but this particular index, which is the equal weight, which kind of erases some of the issues with the Magnificent Seven, this particular index also reached a new high. So I was very pleased to hear that, and I hope that that will continue. I don't feel that uncomfortable with the present market, but at the same time, I would like to see a broader market than just 6 or 7 or 8 stocks.
Yeah, and here's just to make that point. And like I said, I wasn't aware that it happened on the S&P 500. But keep in mind that value line arithmetic average is also an equally weighted index. It's basically the Wilshire 5000 in air quotes again, only equally weighted. And that there's just the equally weighted indices have generally performed better than the market cap weighted cousins. And that's just simply a nod or a tip of the hat to all of the above investing. We like to invest in small, medium, and large companies, and that is part of the recipe for success. And you can see here that on this chart, at least for the 20-year period going back to 2003, this just confirms what Barry had pointed out for year to date this year. The RSP is the exchange traded fund that represents the S&P 500 equal weight that you see down the middle here. And the stocks that are mentioned here, you guys already know this if you've been here before, are the 10 most actively followed stocks by Manifest Investing subscribers. Anything else you'd like to add here, Ken?
No, but I do think that you're able to invest in that index just like you can invest in any other index if you choose. Am I right, Mark?
Oh yeah, RSP. And in fact, if you're intrigued by the notion of the RSP performing better than the traditional S&P 500 SPY, we did a whole series on Jim Cloonan's book. Was it Rule 1 Investing? I know I've got it here at my Investing at Level 3. Jim Cloonan, if you want to dig that out, and we did cover it in a bull session in the past. So
Patricia in our audience, Mark, is telling us that you could find it on Yahoo Finance with the ticker SPXEW.
okay.
SPXEW. Okay.
Yep.
That's the index's designation, and RSP is the index that invests in that particular index.
Mm-hmm. Yeah, many of the different brokerage houses have their own flavor of it, but they're all basically doing the same thing. All right, well, let's check in on our groundhogs, and it is just the top 40, but Ken B.I. Baker did sneak back in. I noticed
that. I feel like I'm holding on by my fingernails to the top 40 here now. I keep sliding down the list here. So,
well, when the market goes through these tougher times, at least this has been our experience over the last several years, you notice these that are in italics. These are our celebrity participants, and they tend to do better when the markets are nastier. Don't ask me to explain it, at least not right now. And but they tend to kind of float up the list. So you can see the italics are kind of gaining ground. And I do find it comforting that the ones in bold, those are investment clubs, are holding their own very well. Now there's a whole different breed of performance up here at the top. That's he gets his own page here pretty soon, but that's as wide of a margin we've seen in 17 years.
Yeah.
How many losing groundhog portfolios does Jim Gallagher make up for?
A lot.
We'll have that stat at the end of the contest, Matt. Okay.
How many? Yeah, and we'll try to get Jim. Jim actually was a guest at the Wednesday morning breakfast club, sponsored by the Heart of Illinois chapter last week. So we got to hear from him, and he was probably tipping a pina colada and headed for some island in the Gulf. Not a bad deal. He actually does own a few shares of that company he invested in. Not a huge amount, but some.
And we do not want to overlook those folks that are at 25% and above.
No.
I mean, those in a normal year, those would be, we'd be open mouth gaping at those three, Ellen Hall and Keith Tubbs and Keith Adamski. We really think those are exceptional portfolios as well.
Mm-hmm. And I should mention that Joe O'Brien could probably help out with the Chicago hot dog analysis. So I may invite him to do so. Joe's a friend going back many years, and he's probably also gifted when it comes to that. We can also bring Susan Jabinski into that conversation from Morningstar. Susan actually makes the list at number 40. And yeah, we do share her ideas at Manifest on a routine basis. And the reason is she's made some wonderful selections over the years, and she tends to think a lot like us. Her three selections in this year's contest are Kenvue, Campbell Soup, and Gilead. So you can see that they have done fairly well, and she's moved up the list quite nicely. The average groundhog has dropped down to 5.7%. It was 10.6 here. So it's been a rough September so far for many of us.
It has. Number 13 is in my investment club, and I'm going to have to call Don onto the carpet and ask him where's all his ideas for the club. You know?
Step up, man. All right. I couldn't resist sharing this one. We've talked about this one a few times over the last few months, but I had started mapping, how we look at the stock market in terms of zoning, and that's in air quotes. Basically, how do we see the market? And every week we look at the companies that are in the Value Line Standard Edition. In this case, it's number 6. And I would just argue that we see something different. If anybody sees something different than that, please send me a card or a letter or something, because Ken, I think this really does kind of explain some of our selectivity. And when the rhinos are basically out there, the Wall Street analysts see a majority of buys in issue 6. Again, this is limited to the companies that are in this week's update batch. They're seeing something we don't. So
I think the key is also, Mark, that our green bars and red bars tend to stay roughly equivalent to each other, as opposed to the rhinos, where that green bar is always, and I shouldn't say always, almost always the longest of the three that are on the graph.
very true.
We tend to try to keep our zoning kind of ideas in as close to a nice distribution as we possibly can, and that means there should be roughly as many sells as there are buys, and these graphs look pretty similar. The green red might be a little bit higher sometimes, and the yellow shorter, but basically that picture is pretty standard now, as we've been looking at this picture for the last 5 or 6 months.
Yeah, and we'll keep doing it just to watch. And so, like it says here, we are different, and trust me, we're okay with that. All right. Well, Kim sent this one over. This you may remember within the last year, we actually issued a bit of a warning on Big Lots and talked about their store closings, and just there were a number of people. Oh, by the way, in here somewhere saying this is an opportunity, a value opportunity. We said we think it might be a value trap, so we're just going to do a little bit of a bow and say at least you can count this one in the win column a little bit. And Kim, you're in mourning over the stores closing around you?
Well, the stores were more in Evansville than here in Florida, but there are certain things I always like going there to get, especially Christmas time, Christmas wrapping, gift boxes, and I have a tendency to make gifts of food, like cookies or seasoned cashews or peanut brittle or all this kind of stuff, peppermint bark, and those boxes that you could find there are, I don't know, 75% cheaper than going to Michael's.
Well, it's a big loss. No no pun intended there. I mean, it was a favorite for some of our family members also for precisely the type of thing you just described. So
You'll
there you
have
go.
to switch to Ollie's Bargain Basement, Kim.
Yeah, I hope
No, hang
Ollie.
out either place.
We like the Ollies around us, and we hope they continue to thrive. They seem to have been doing fairly well. All right, this is a little bit of a busy chart, but I think it captures a lot of the activity and mental gymnastics that go along with a company just beginning its life cycle. And Kim, what's your favorite part of this?
Well, for me, it's when it's at the peak, and then early adapters, and then you're finding out what the trough is and how figuring out what you can do to determine whether or not you want to keep the shares that you have and add to it as it goes down, or do you need to just walk away because you've reached your peak and there you go.
Yeah, it's tough hanging on to a company. We'll talk a little bit about Luminar here in a few minutes, but many of us have been tracking Ardelyx since Hugh McManus first brought the company to the roundtable back, I believe it was 2014. And so
I haven't had mine that long.
but he's been following that company that long, and so he has lived personally through all of this. And you can add FDA gets in the way and messes you up somewhere on that blue line. But
yeah, that was a lesson with biopharmaceuticals I did not know about, but I sure found out.
Yeah, we all went from $9 a share to 60 cents a share in a couple of, well, I swear it was 15 minutes, but it's something like that. Ken, what are your thoughts? What do you see here?
Well, I really think that the examples, the identifiers on the different dots match what's happening with LAZR. That's the Luminar, the LiDAR company that we've been extremely interested in off and on now since the BINC convention. And I can see it happening, and I say to myself, well, are all these things, have they happened in that company? And I think we're down near the bottom of that first big slide, the slide off the big tall hump, and I think we're moving towards that dot right there that says less than 5% of the potential audience has adopted. Matt, you're the person that's done so much research on this company. What do you think?
Yeah, well, I hate to bear more bad news. I think what needs to happen, the industry has consolidated. They've had a number of mergers. All these companies got funded in 2021 when debt funding was cheap and venture capitalists were spending it. And so they combined operations to sort of consolidate their order book, right? You need twice as many customers you have it, and then to consolidate cash. I think you probably need to hear a few of the competitors go out of business, and then they'll really know. And of course, that will be bad news across the board. That's the reason why it's bad news. In good news, Luminar's first automotive OEM customer, Volvo, is commencing or has commenced with customer deliveries of the EX90, which is equipped with Luminar this month, actually by today. In fact, Luminar's CEO sent out a letter that he got his EX90 yesterday, which he bought. That wasn't an engineering vehicle for the company or something. He bought one. So it is real and it is happening. And as I said last week, there's plenty of opportunity for safety reasons and eventually for autonomy reasons for the company to go. If there's not an extreme change in regulation, automotive safety becomes one as well. With right now a requirement for pedestrian safety that only Luminar meets today. Not that they're the only ones who can meet it, but by 2029. So if someone wanted to gin up a competitor, they would have a very short time to do that in and get it all the certifications, all the testing and everything, and sell it to customers. So that's kind of another trump card somewhere in the hand. but we'll see what happens. But in terms of the hype wave, I think we probably haven't thinned the herd enough to really see clear winners.
Yeah, and they did announce.
Matt,
Go ahead.
I'm sorry. Go on, Mark. Okay,
I was
Matt, is it fair to say that adoption by Volvo is way less than 5% of the potential audience?
Oh yeah, Volvo as itself is a niche player. It's luxury, but it's not quite luxury as it gets into Lexus or Mercedes. That'll be the next one. The next good news that should happen sometime probably during the winter auto show circuit would be Mercedes-Benz announcing vehicles equipped with Luminar. Both of those companies have said, and these aren't, and of course, commitment is a hard thing too, right? Auto companies sign contracts and then they write purchase orders only, as the plants need parts. So people nitpick about what commitments really are, but both companies have said they plan to deploy Luminar LiDAR across their model, their entire model spectrum as they roll over new models. So it's not, I liken this to how Gentex rolled out with the auto dimming mirrors. Mm-hmm. They tended to be luxury items, they tended to be options, and they tended to be niches. So one or two OEMs had it, and everyone else looked to see if it was differentiated or not, and then they went and got on it too. The commitment for Volvo and Mercedes, I mean, they are the types of companies they are across the board. I don't know that Mercedes is standard, but Volvo is standard as a safety precaution first. Again, if NHTSA's directive holds, then everybody would have to have it standard too, or something to its equivalent.
So maybe their announcement of possibly needing a reverse split is somewhere in, definitely in this trough of disillusionment with the current stock price. We'll see.
Yeah, that's another good signal. It's there. It's kind of like when a company has a kitchen sink quarter. You just get rid. I mentioned in a private chat, Luminar was already looking to have a shareholder vote to possibly raise the authorized number of shares because they've been paying suppliers partially in equity in order to preserve cash, and we're actually reaching their limit. So the reverse split addresses that issue as well, as kind of addresses multiple birds with one stone. Certainly, if they came out around the time of the vote with news of the second $100 million funding that they needed, which might be a purchase in of those shares, that would be kind of a kitchen sink quarter.
Well, we'll keep hoping. All right, so if you want to know more on the subject, the link on the lower left actually takes you to the reference that I'm sure Brian was referring to. And Kim wants to share one reason that she believes that Ardelyx is on the right-hand side of this chart, and I think this is an excellent deep dive on the company. Go ahead, Kim.
Well, there's a few things that I've learned that when you have a biotechnology company like this, you have to follow everything about it. So one of the things I did is I've been following in LinkedIn, because every time they have more jobs posted, for me, it believes they wouldn't be posting more jobs if they didn't feel that they have more sales they can capture, but they don't have enough staff. And if many of you may recall, they started off with like 60 drug reps, which the new term is not drug reps. I can't remember what it is, but then they doubled it to 120. Now they're adding in all these managers and for patient services, medical science directors, and development. And some of these are specifically for GI, which would be for the GI drug of tenofovir, and some of them are for nephrology, which be the kidney drug Exfosa for the excess phosphorus in the blood for the kidney patients. And look at the price of these positions, what they can get paid: 165K to 181, 171,000 to 210, 216 to 264 for a director remote. These are big paying jobs, which to me means they expect to have big time growth in sales, and as a result, they're going to have more cash flow coming in, which to me is all growth, and they wouldn't hire these people if they didn't expect to have more sales, because when you look at some of the other, the Yahoo Finance and the Seeking Alpha and the Y charts and all that, they're all expecting the stock price to double from what it is now. So to me, this is always a good thing. And as a sideline, they have a partnership with 3 different companies. One is in Canada, and it does sell the irritable bowel syndrome drug of Isbrella, but I cannot find anywhere on their PowerPoints or their information anything about if they're doing anything about the Exposa drug for the excess phosphorus. Also in the Japan company, they're selling the irritable bowel drug, but I did find that they have already reached 50% saturation of what they think their market share could be on the drug. And in the past, once they've met certain mile markers, they've had to share with Ardelyx some of their profits. So I'm anticipating in the next couple of quarters, we're going to see a royalty payment to Ardelyx. And as the previous slide, Mark, you know, where it talked about supply chain issues.
Mm-hmm.
This company, the Japan company, which I can't pronounce it, is going to be building a plant in the United States for any supply chain issues. And they have partnerships with Amgen, they have partnerships with Johnson & Johnson, they do research studies. Yep. And in their PowerPoint for the last quarter, I found that for Exposa, I believe it was Exposa, they had 3 different clinical studies going on with the drug, because Japan is very different, is they won't take any of the data that we have in the US. They have to do their own clinical studies and data for anything. So this is like more good news for Ardelyx in the fast and short of it, I believe.
Yeah, and I think in the past
Kim,
I've shared, well, let me just finish this thought and then you can take it, Ken. I believe it was Chuck Allman. I wrote an article for Better Investing magazine years ago where it was talking about small companies, probably just after I met Ken Kavula at that meeting for lunch, Ken, that you will remember back. How many years ago would that have been? Anyhow,
long time.
So we talked about a lot about the small companies. Well, Chuck Allman, the growth, I don't remember the exact name of his newsletter, but one of the things he would point out, if you could find a small company and then look in local publications, local newspapers like the Dinosaur Ken, and anybody who's really hiring, that's a tremendous rubber stamp of approval for having more confidence in the company going forward. Because very rarely will a small company add staff and then go off the cliff. It's just not. It doesn't happen. It happens. Doesn't happen quite as often. So, in your thought, Ken?
Well, I have 2 things now since you made that comment. First of all, Kim, we have a question from the audience. Exactly where did you find this information in LinkedIn? How did you get to this information?
I went to LinkedIn, I signed in, in the search box, typed in the word Ardelyx. It comes up with the company, and then you look at the taskbar and they have jobs, like when they are posted, the entry-level salary, all that, as you see, but then it has all the other information. I just snooped around in there and I went, whoo, this is a treasure trove of information.
Okay, that answers the question real nicely. And then Mark, that used to be a couple slides in a how to find small companies presentation, where we would encourage people to use the data sources at the libraries that at that time had local newspapers from many of the major cities throughout the country. And we would say that if you could find a local newspaper near the company headquarters, you should be searching that newspaper as well, because many times you'd pick up facts there that you wouldn't pick up in the national news. And we used Detroit as an example when you were looking for information about General Motors or Ford. So that concept is still in place. It's just that we don't need individual newspapers anymore. We can begin to use AI. Just another good reason, I think, why investors should be starting to experiment with some of these AI engines. Some of them yield beautiful, beautiful results, and some of them yield fantasy. So be very careful with what you're reading, but get used to them and play with them. They're a lot of fun to start with, and they can start to help you on your research tools as you're asking simple English questions and actually getting answers to those questions. And a lot of times the answers are right spot on with what you're looking for.
Absolutely.
Ken, I enjoy the technical term. The technical term when they get something wrong is they hallucinate. So imagine your very smart, very well-read friend that occasionally hallucinates.
I was trying to think of the word. That's the word Jim Cramer used this morning when he was talking about reading one of the engines, and he said he didn't know where they were, but they sure were hallucinating. They must have been smoking something, he said. So.
Excellent. Well, speaking of hallucinating, go ahead, Kim.
I just see one question here that Kevin Gilogly is asking. If I can repeat when to use LinkedIn as an investor. I have found LinkedIn to have information as an investor of things I may not have thought of. Like they may have an article about where they did, the drug reps did a national convention and what they presented, and what the results were from the attendees of how they thought the information was. It has job postings on there. You have to just read everything what's getting posted out there, because sometimes I've actually found maybe an article about a new hire there that it may not be really put out much in the Ardelyx PR information, but it may be put out there on LinkedIn of congratulations to Bob Smith, who's now been hired, and this is their background. So then you can kind of correlate as to, okay, they're hiring in this area, and this area, and what does that mean? And you interpret it.
Good stuff.
So that,
thanks.
Yeah.
All right. Well, speaking of hallucinating, we're not hallucinating. September's been rough. It's not unusual for September to be rough, so don't be surprised. That's what the graph on the left says. I think Matt provided that. And then on the graph on the right, we did actually go back to a traditional yield curve where the 2-year treasury is less than the 10-year. And that has been pretty messed up for quite some time. That's what you're basically looking at, a graph of the yield curve inversion that you'll hear talked about all the time when the 2-year is actually higher than the 10. And that has persisted a couple of times. Every time historically, again, limited data here, but it's been a fairly reliable recession indicator. And again, we in our community don't get too hopped up or too anxious over recessions. Messes up some of our stock studies. It exposes some of the companies that probably are on the path to bankruptcy or acquisition anyhow. And what we just recently went through was big and different and special. And so you will be hearing people predicting Armageddon or whatever, apocalypse. But notice that the recessions occurred after the recovery from the yield curve inversion. So it's just there.
Mark, is the lack of data due to the fact that the 2-year treasury is a relatively new instrument?
I don't know the answer to that.
I don't think the 2-year treasury has been around as long as the 5-year and the 10-year treasuries. I might be way off base on that, but maybe somebody in our audience can check us on that.
Okay, if they don't, I'll check it with my AI generator. All right, let's go ahead and move on, because we want to skip past this subject, other than just to remind that we are in the middle of this effort. If you find an interesting small company, send it our way, and we will continue to build that out for the next month and a half as Halloween approaches. So with that, Ken, if you're ready, let's go ahead and crank on the Buttonwood portfolio a little bit. This is going to be kind of like a traditional investment club meeting. We'll basically start with how are we doing, and what you see here is the original cash deposit and the monthly infusions of cash. This column here basically says that the average return on our stocks, and it's early, so again, don't get too carried away with this. Give it some time. but 1.1% right now is the average return, and that's a simple total return for the stocks that are in the portfolio. And we were as high as 3,100 back here on July 16th. That's actually a Robinhood graphic down at the bottom. And the column over here on the far right is basically purchasing shares in the VTSMX, Total Stock Market Index, so that we can measure how we're doing versus that index over time. You can see we're behind, but again, we're in the first half of the first half inning. Okay.
We don't even have our first out yet. Okay.
And again, when we roll over into slightly more than a year, this will convert to the conventional rate of return that you're all familiar with on your club accounting or personal record keeping. So right now it's just a simple return. Here are the stocks in the portfolio, the 16 stocks, and how they have done. We have invested 162.50 in these if you're keeping score. And you can see a little more than half of them have gained and a few of them haven't. So here's the number that we're working with to start with today, approximately $269 in cash and that 2870 average. Any comments or questions on this, Ken?
Well, I would like people to begin right at the start of this club to keep a real close eye on that percent of total column, because that becomes more and more important as the club is older and older and has a change in stocks and different stocks. You want to make sure that you don't let something become too large, and you want to make sure that you don't keep around something that's way too small. I don't think that we're in either category at the moment, but we want to keep an eye on that percent of total column. And in addition, we want to keep an eye on the column right next to it, that growth column right there, because that's telling us what sales growth is for all these different stocks. And we're looking to try to populate this portfolio with stocks that have double-digit sales growth. We'd like to keep the average around 14, 15, and it's at 15 right now. That's a weighted average down at the bottom that Mark circled. And if you read down, there's a couple 9-point round off to 10s or close to 10, but there's also a couple of slower growers in there that we might want to take a look at as we continue to talk about making the portfolio better. And then, of course, the most important column for an investor is what's the potential return. That's the final column. And we're down at 12.6. What's my part today, Mark? Do we know?
Good segue.
I know.
Well, we're looking for 9%, so we would like to see this aiming for 14% or more. Again, 9 plus 5, 14. So that 12.6 is a little bit short. So as we go through our thought process for the portfolio, this is Ken's report card. And again, we're okay with that 12.6. We just want it to be a little higher. Everything else checks. You have a problem with any of those, Ken?
Not with any of those except for par, of course. And folks, what you can do now is, since you're a brand new member of a brand new club, you can tell yourself, if you want to raise the par, the way that you raise the par is to buy stocks with par higher than 12.6 and or sell stocks with pars lower than 12.6. This ain't rocket science, folks. Okay, so that's our goal, our short-term goal for the next couple of months. Let's try to get that up to 13 and a half, 14, 14 and a half if we can. And that means we got to kind of focus on it a little bit. Yep. Right now, the stock that we have on the hot seat is Thermo Fisher, and its par is down under 5, and we do have a little bit less than 10% of the portfolio in cash. So let's do some work and see where we can go with this.
Here's a quick look at that other sort that we had done for the roundtable recently, and I kind of like it. I might even work with this a little bit more. It's basically ranked by this column right here. The manifest ranking is a combination. It's almost like our own index that combines the projected annual return and the quality for the companies. So it's a combination of those two characteristics. The stronger you are in both of them, those are the ones that are down around the 100. So the ones that are weakest from either a quality or a return forecast standpoint are up at the top of this chart. And so again, in combination with just thinking of the overall portfolio, those companies at the top would be the targets of any challenge to the portfolio. And
Yeah,
again,
I love to draw lines, Mark, where I see natural divisions, and I see a natural division going right between Viva and Excelis, that 71 to 83 jump. And then I see another natural division going from Diageo to Vertra, that 88 to 91 jump. It's not nearly as dramatic as the first one, but it's there. And I would like to say to our audience that I think anything from green brick on down the list are safe from a lot of things that are going on right now. And that next group up from there are almost safe. And the group above that, the Diageo Excelis group, are sort of safe. And then Viva, Thermo Fisher, and Luminar is where we do our playing around at the moment.
so it's kind of like an episode of Survivor, which I never watched, but apparently that's what they used to do, right?
Well, it's kind of like giving out A, B, C's, and D's in a math class too. Okay.
Are we going to a bell curve here now?
I wanted to avoid that conversation with the principal, that sort of thing. Okay, the one thing I would point out here, the RSI here is just for informational purposes. That 71 with Viva means that it's been hot. It's been potentially overbought. So that's one of the reasons it's up towards the top end of this chart. And the ones below 30 are the ones that are 30 or below, have been cold, possibly oversold. And the rest of the opinions there are just simply, what does everybody else think of our stocks? They're not always going to agree with each other, and in fact, quite often they disagree quite a bit. So it's just something to keep in mind as you keep it in context. Well, here's a quick look at Thermo Fisher's price performance over the last several years, along with the value line close on the right. And again, this is a solid company, very, very solid company. And they benefited from COVID. We'll take a look at that in a second with the sale of their products and their instrumentation and medical devices and all that stuff that they provide for labs, for medical labs. And but they've been in kind of a flat spot for a number of years. And in a different period portfolio at a different time, this is actually a potential sign of strength that they've traded in this range for a while and could be taking off. So again, we'll basically back up to, well, how does it fit in our portfolio? And at least Value Line is of the opinion that they will continue to struggle from a price perspective. No idea if they're right about that, but that's just the general look. Here's a look at the company. Again, very high quality company over time.
I think some things, Mark, that I didn't understand about the company when you asked me to take a real deep dive into it a month ago was how large it really is. It just dwarfs most of its competitors. It's the largest supplier of medical devices, medical doodahs, medical things to the entire world. And it comes from a catalog that I never associated with this company that I used to use when I was a chemistry teacher.
There you go.
Would get this big, thick catalog just full of anything that a chemistry lab might need to have to stock it well. And then you could pick the items out there, and within a week or 10 days, they'd be sitting at the school door in big corrugated boxes where you could unpack them right into the lab. This is essentially a catalog company, and They are voracious acquirers. They will acquire almost any company to fill in gaps in their product lines. When you read the information on their website, you begin to study the acquisitions they've made in the last 5 or 10 years, you find that they're making fairly decent size acquisitions on an extremely regular basis, and their short-term basis, 2 or 3 months a lot of times between acquisitions, and they're trying to plug holes in their in the line of goods that they offer to the general public. They're trying to make it so that no matter what you're doing in the medical field or the research field or the teaching field, the academic fields, no matter what you're doing, you can go to them and do one-stop shopping for all the supplies you might need. I didn't realize that. I think they've gotten so large that the law of large numbers now begins to affect them and slows their growth, so that you see growth in sales like you're looking at on the graph right now, which is pretty much in the last 3 or 4 or 5 years non-existent. It's been extremely flat, and it's projected to stay relatively flat pretty far into the future. I think is that about 3 or 4% growth that line's measured at, Mark?
Yeah, it's close to 5.
Close to 5. Okay.
Keep in mind that they had an incremental bump up in 21 and 22 from COVID. So I mean, you're basically talking about a company in that 5 to 8 range. If you wanted to be very optimistic, maybe you go with the 8. But based on what Ken just said, I think as you do the analysis of a company like this, you really want to place a lot of emphasis on the most current couple of years and the expectations for the next, 1, 2, and 3 to 5 years, which is that circled area on the right. And that is closer to, as Ken just mentioned, a 5% growth rate. Again, nothing
I'm
bad.
reading
That's not bad.
I'm reading my SSG that I did, Mark, and I used 4.5% for my sales growth forecast. So I was a little bit more pessimistic because I wasn't seeing earnings matching anything near 5 or 6% as far as earnings growth was concerned. I was seeing earnings growth, and that's that blue line down at the bottom down there, I think.
Yeah.
No, that's price. That's price. We do have price bars above it up there. Okay.
Mm-hmm.
And I think anybody can see that the last 3 or 4 years have essentially been flat in the price. Mark is projecting again out into the future, as we do always at Manifest. And but I think this is a stellar company. It's a high quality company. It has customers all over the world, and it has a huge moat around its business.
Mm-hmm.
But the question is, how fast will it actually grow, and what will it return to an average investor over that time period? And your analysis, which I think is a little bit optimistic, is only showing 5%.
Yep. So that's what we're dealing with. A company basically at 5% growth, and that's with a PE. Keep in mind that 5% growth projected annual return is based on a PE of 31.5. That makes me a little bit uncomfortable with a company this big. And
makes me a lot uncomfortable.
So we're looking at the situation here of it's at a multi-year low for projected return. That's because it's done better here price-wise lately. Here's a look at the profitability over time. You can see that they did have a bump in profitability thanks to COVID. You can see that Value Line's low total return forecast now is in low single digits. Morningstar thinks it's slightly overpriced. And this is the one that kind of gives me pause. I look at the PE chart. I don't know where to go with it, but I have a hard time getting up to here. And, you basically drop that back to 25 to 28 even, and you're talking about a company that is in very low single digits. So I think our attitude here is to sell it, and the basis is not any quality weakness in the company, but we simply are making an effort to improve the overall portfolio return forecast, the projected annual return, and hopefully bump the growth on the portfolio a little bit. Fair enough, Ken?
I think that's absolutely fair, Mark. And to do that, we should start by looking at what's already in the portfolio about whether we can put some of our cash to work in some of the companies that we really think are stellar that are in the portfolio already.
All right, so here's our Sweet 16 from last week, and I've gone ahead and whited out the stuff that would be distracting to Ken. And I left the Yum China and ACM Research in there, but I gave them red arrows because they're both Chinese companies, and we'll talk about that in a minute. But of the 16 companies in the current Sweet 16 that could be potentially attractive, Gentex, Lulu, and Schlumberger are already in the portfolio. So we might want to think about potential accumulation when it comes to them. Any other thoughts, Ken? I mean, the ones.
Well, I went through this. Yeah, I went through this chart, and I think the cream of the crop on this chart right now is Schlumberger. It hits the top or near the top on every single category, and the top isn't necessarily the best on some of the categories, so it hits the best place on each of the categories, or near the best place. And especially when you compare just those three to themselves, I would suggest that we take some of the money, Mark, and put a little bit of it into Schlumberger and a little bit of it into Gentex, those two.
Okay.
And maybe we're dealing with really small amounts of money, folks. You could add a zero to it if you're creating a better portfolio, but I'm suggesting maybe just $100 in Schlumberger and $100 in Gentex. That still leaves us then with over 250 to maybe get some money out of one of the stocks we sell and then buy something new.
Okay, and one last comment on the company Yeti. I love the company, love their products, but they are somewhat guilty and somewhat vulnerable of being something of a single product company. You want to always keep that in the back of your mind. If you're dealing with a single product company, there is a vulnerability, a competitive vulnerability. And again, love the company, love their products, and they do look pretty good, but it's just something to be aware of, that vulnerability. And here, this slide is just simply, we're not making this stuff up, folks. I mean, we have talked about China in the past, most recently, well, a few times recently, but back in July, about three years ago. Can't believe we've been doing this 3 years, over 3 years. We did talk about this documentary, The China Hustle, which I would encourage you could just go to YouTube and type in China Hustle, and they will talk about some of the shenanigans that were happening overseas. And it ain't a pretty picture. It's just something to be aware of. And when we talk about an elevated perception of risk, is that sugar-coated enough, Ken?
That's sugar-coated enough, yes.
Yeah. So
or pork coated enough.
Or pork, yeah. Pulled pork is painful to us, but just something to keep in mind. I mean, I've looked at companies like this one. I looked at it for years, never pulled the trigger on it, and then at some point they did something wrong and things got kind of messed up. So again, just we're not hallucinating when it comes to China. So here's the portfolio. Here's the decision that we will make. We'll actually walk through a demonstration of this here in a second. We're going to sell the TMO and convert that to cash, and we'll just dig in and go a little bit deeper. But before we do that, just want to again point out that when we go to this worksheet and you sort it from highest projected return to lowest, this is what you end up with. The companies up here are accumulation targets, and Ken already mentioned them. I believe, Ken, you mentioned Schlumberger, Lulu, and Gentex as potential opportunities for accumulation. Luminar is yellow carded, not because we don't love it, but because it's clearly early stage and very speculative. And I don't know, Ken, I'm of the feeling that 3% in these is probably enough.
Absolutely, Mark. And we're giving ACLS a timeout for the moment, trying to track down some negative information that we received about the company to find out if it's true or not.
You're thinking of ACMR.
I'm sorry, I got the wrong ticker. Yeah. Okay, it's ACMR that we're giving a timeout to, right?
Mm-hmm. All right, so that's the look. I mean, that's where we'll be shopping. And then just again, that same chart, just as a reminder, these up here are yellow carded. We don't have to worry about thermo anymore. And then Ken also posited again in the theme of thinking about other topics which we might explore in bigger depth, started with Fortinet. And Palantir was actually very high on the list, and the market didn't cooperate, Ken.
Well, the market didn't cooperate by boosting it a whole lot yesterday.
That's yesterday, folks.
Yeah, yesterday's gain 14%. Oh, do I wish I would have bought it last week. They're interesting companies in a very interesting industry. It's cybersecurity, and I don't feel that the par values are particularly enticing for either one of them right now. My experience is that when my SSG is done, my par value will come out somewhere within a couple percentage points of the manifest par value. So not particularly interesting to me at all. Mark, I'm not quite sure why you have this one at the bottom with the red arrow. Can you tell us about that one?
Well, that's, it's in the same field. It's an AI company. And
okay.
the reason it's down there and it didn't even make the list is it's pre-earnings, and I didn't think you'd be able to handle it being up there with the other companies.
Okay, great.
Their earnings are still negative. But yeah, when Palantir, when we do the next update on this, I expect this number will improve. And for those of you out there that are interested in the company, both Matt and Marie Frank do quite a bit of work. More so Marie. Not that Matt's a slacker, but Marie really tracks this company and reports quite frequently on developments at Palantir. So we'll find out if we can do that. So again, Ken is just shopping for companies that might splash in somewhere into this area for potentially buying outside the portfolio. One thing that I thought might be interesting is just a quick look at other companies related or somewhat similar to Fortinet, and basically we just want to look at the industry group, software infrastructure, sorted it by quality, and then went looking for companies that might have a decent return forecast. This one kind of pops a bit. We'll talk about that one a little bit as we think about the portfolio also. D-Local, ticker symbol DLO.
VeriSign is in there, but they have twice as much debt as they have equity, I believe.
Yeah, could be.
Yeah, okay. We're not saying buy anything on this list. We're just saying we're coming up with ideas, trying to fill a portfolio and not avoiding looking at competitors whenever we can.
And this one here is probably a worthy study. It might be a little bit down the middle of that early stage chart that Kim put up a few minutes ago, but it's got some numbers. But are those improving? Probably. I know it's been a Motley Fool favorite for quite some time, and Marie also talks about CrowdStrike from time to time.
Mark, I will. I'm sorry. Go on, Matt.
It probably has a kitchen sink quarter coming up as it
CrowdStrike
makes some kind of guess, makes some kind of allowance for liability from the incident they had in July.
Absolutely.
Yep. And Mark, I'll draw people's attention to Synopsys, SNPS, on that same list, up there in the third spot, only because I just did a quick down and dirty SSG on it and was really quite impressed with the down and dirty part of it. Now, I haven't delved into what the company has behind the curtain in any great detail, but I was very impressed with the visual analysis and with some of the early numbers I was able to pull off and pull together. So that's another great study, I think.
Yep, and of course, you can always back into this one virtually anytime you see those type of numbers if you're looking for relative safety. Here's a quick look at D-Local, ticker symbol DLO. This was presented at the National Convention by Pat Donnelly. He's a information technologist that works in the management consulting field. So he deals with companies like this all the time, and this happens to be a company which is apparently a fairly direct competitor to companies like MasterCard and Visa on a very global basis, and we'll look at that. But you can read the description on the lower right there, and yeah, there's some reality here. I mean that the trends for both sales and earnings are compelling, and the return forecast and quality are compelling, at least at a glance. Here's a brief description of what they are. Again, it's a payment processing firm that concentrates ex-United States for the most part. I think they do some business, but for the most part, the lion's share of their business is apparently across Latin America, East Asia, and Africa. And just a quick slide. I mean, in terms of field of opportunity, that's a pretty powerful graphic on the upper right. And on the lower left, the companies that they have worked directly with, you will recognize a great number of those logos, if not all of them. So it's interesting company. Again, interesting trends. Probably belongs on at least a scratch the head list at this point. And anytime Pat and Susie Artsberger talk about companies like this, it's another good time to listen to. I think of them as fellow club partners. Did I say something that won a prize?
That's your team.
Ka-ching. That was a ka-ching, wasn't it? Could have been Kim. And then Ken also wants to bring this one to the top of the pile for consideration. And I don't see any reason not to. This is a Ken Kavula stock for sure.
I just brought it because we don't have a big presence in financial stocks in the portfolio. D-Local, of course, would be a financial stock. I'm sorry, Mark. Natalie, could you come take this for me, please? And Raymond James is a well-respected broker. It's not large like Charles Schwab. It doesn't currently have the same business model as Charles Schwab. No huge bank attached to it or anything like that. And the book value certainly seems to be moving in the right direction along with the earnings and everything. In full disclosure, I happen to own this in one of the investment clubs that I belong to. But it's a good, solid company with a nice high quality rating we might want to take a look at. Mark, we're getting all kinds of suggestions, and I just did a down and dirty on this company also. They'd like us to add Meta to the list as well. We had somebody beforehand, Herb Lemko, suggested we take a look at it. Now I'm getting Meta screamed at me in the question boxes here. So
all right, well,
let's put Meta on our list also. Okay,
I'll put it on the list, but my wife might veto that one. Okay, so let's go ahead and demonstrate some of the stuff we've been talking about here. This won't take long. I'm going to actually go to Manifest Investing site, actually go to the Buttonwood portfolio. So again, this is where the portfolio lives. And here's how you access the worksheet. If you go into the worksheet, pull it up, we're going to hit the reset button just so we get all current data, all current companies. And then I'll go ahead and here's our situation. We'll sort it by par so it looks like the slide from a few slides back. So what we're going to do is sell this Thermo Fisher down here, and we'll hit that green arrow. That basically places that company down into purgatory, and you will notice that the $186 has been added to the cash. Everybody with me on that? Okay, so it's there in the cash now. So what are the other companies we're talking about, Ken? We are talking about possibly.
Well, let's add RJF.
Okay.
So up at the top up there, you can hit that plus button, and you can just add a ticker.
Okay, and we will sort it again by par just to show everybody that it's there. Should be there now. Raymond James is now right in that nice area of the approaching the sweet spot, right down the middle. It has no shares yet, so it has zero for a value, 0 for a percent of total. And
let's add that D local that we were fascinated with, Mark, the DLO.
Okay. And you'll see why that came up in our results as potentially interesting, because it does land up here. Again, a little bit speculative, a little bit early stage, or quite a bit early stage, but it's
Quite a bit early stage, right?
occupying a deep
And
spot on the chart.
let's see, we talked about Schlumberger and Gentex. They're already in the portfolio. Why don't we add Meta to the list as well, Mark? It doesn't do any harm to add a 0 share company to the list.
Can I put it in purgatory immediately after adding it?
No, just add it. Be kind, because the gentleman that suggested it first is an awfully good stock picker.
Well, yeah, I get that. I get that. Well, thankfully the par's low enough that it won't be disruptive here. All
and
right.
I think what you're going to hear from people in the audience, Mark, is that par is awfully low, but it also has data that's hasn't been updated. If you're using value line numbers, they haven't been updated from June. So there's a new value line going to be coming out, and everybody's telling me that this company probably has a little bit more par attached to it than that. I will say, when I did it down and dirty using some numbers that were a little bit more aggressive, I ended up with a par that was a little bit higher than the manifest par as well.
Okay. Well, we'll see what the analysts currently think.
Yeah, see where they're coming from as we come near here. But
all right. So
I think now, go on then. Yeah, go on.
So we're talking about the first proposal was to add approximately $100 to Schlumberger.
Right.
And
So
the way that we do that, let's go ahead and
pencil there.
I'm going to add 2.5 shares. So it's going to make
All
it
right.
6.093. So Schlumberger is going to be a little bigger piece of the portfolio now, 246. But you can see that.
And notice, folks, that the cash has reduced itself now. Okay.
Okay. And then we also were talking Gentex.
That sounds good.
How about, what do we want? 3 shares?
3 shares, yeah.
Okay. We could actually do fractionals too, but this will be fine for what we're demonstrating. Well, we're running a little.
I don't know if it took the submit, Mark.
Not yet, it didn't.
Okay.
Maybe we have an internet hogging problem going on. Oh, there it goes. Okay, it's in there now.
There it goes. Okay.
And then I concur with Raymond James. I would like to argue for putting DLO on kind of a watch list.
All right. So we can just leave it on this list then, Mark. And since it has 0 shares, it doesn't impact any of the numbers, but it keeps it at the top of our head, in our mind at least, as a possibility.
Okay, and we could add to Lululemon, but I kind of like the idea of bringing RJF into the portfolio. 1.5 shares will be approximately 150, 160 bucks. So
okay, that's what we've been putting in as an initial position, 150. So that's good.
Okay, so there you have it. So the portfolio now has made those adjustments. You can see that we don't have anything overpowering the portfolio under this percent of total column. We will continue to look at these 2 companies. We'll see how the Meta does on the next update. And
what's so interesting, folks, is that we had a lot of cash in this portfolio, and look what we did to the par number.
Yep, we're down to $90 in cash. We'll be adding 100, and then we'll come back and either accumulate here or add another one from outside the. Oh, a news flash on Apple using a court battle of some kind. All right, and so now we can go ahead. One of the things that I will do is go ahead and save this portfolio to the original. So it's going to replace. We are actually going to make these transactions. and it will go back in the regular portfolio. And one of the things I'd like to do right now is finish the last slide in the presentation. We're going to take the new portfolio averages, copy it. You're seeing PowerPoint on the fly, people. And this will allow Ken to do his principles review of the report cards before and after. Take it away,
Well,
Ken.
remember that my par was 9.6. So at 14.2, we're close to that +5 on the market. We actually improved quality just a touch. We improved growth just a touch. We dropped PE, and that's not a bad thing for us to do at this point, down to 18. We dropped yield a little bit, but not much. Kept financial strength the same, kept EPS stability the same. And folks, we've improved the portfolio. And because we're just starting out, you can do these improvements fairly quickly. The key will be now to keep these numbers right about where they are, to keep that par about 5 points above my par, to keep that quality above 80, and to keep that growth above 14. If we can keep those three numbers there and then keep the other four numbers in the acceptable range, and they're entirely acceptable right now, then we have a shot of having a portfolio that over the long term is going to be able to beat the market by that goal of ours, which is do it by 5 points or more if you can. So I think it's been a pretty solid 20 minutes of work, Mark.
Okay, let's hope for the best for those companies, and we'll take it from there. So we're a little bit long on time, but hopefully you guys get a feel for the what-if capability of doing that type of a session. And we'll come back and do that in approximately 1 month again, taking a look at the portfolio. We do archive all of these presentations on the YouTube channel under Manifest Investing. You can find either bull sessions or roundtables here if you just simply go and search for those as themes or name searches. If you subscribe, we will let you know anytime new content is added.
Mark, I want to capture an idea from the audience. If you would just jot it down, SYY, and we can talk about that a little bit. Remember, we're going to try to run these sessions on Buttonwood every other week. Is that right? Or are we going to keep it to the second Tuesday in each month?
We'll keep it second Tuesday, but we can always do quick sessions over nominations. That would be Cisco Foods,
okay,
the company.
Yeah, SYY. Steve Emmerich would like us to take a look at that as a possibility. Okay.
Pretty sure we just added Cisco Foods to the 10 Cup portfolio, but yeah, it has come up, and it was featured by one of the presenters at the National Convention. So with that, I'll leave you with a couple of early autumnal photos from Michigan. The picture on the right, you've seen us use for educational presentations. That's Tequanimon Falls on the northern peninsula in Michigan. And I'm sure, Ken, you're familiar with the boat on the left.
Yep, well, I don't know which one it is, but those are maybe the two different freighters, ferries that go across Lake Michigan.
Yep.
From one from Ludington over to Milwaukee, and one from, I think, Muskegon over to Milwaukee.
Yeah, those are both the Badger, though. And
are those both the same boat? Okay.
I think I saw that it was the last trip for the season, at least nighttime trip for the season. And that's a pretty interesting photo that they captured down there at the bottom. Anyhow, just those of us kind of hugging over the state of Michigan. It was either this or pictures from my soccer tournaments this weekend with my grandson. So I went with the waterfall on the boat. All right. Anything else in the hopper, or anything that anybody would like to discuss? We can shut down and stick around if anybody has questions.
No, we've done a pretty nice job. Thanks to Matt and to Kim. Matt has been answering a lot of questions in the back room, so that's helped out an awful lot. And I think without further ado, I have to get ready to visit B.I. Baker tonight. We have an in-person meeting If you're in the Grand Blanc Flint area and would like to come to BI Baker, it starts at 6 o'clock at McLaren Library. If you're around the area and want to come to an interesting meeting, we'll be there at 6.
It's a good group. They'll be celebrating their ranking in the Groundhog Challenge.
Yes, we will.
All right. Thanks, Ken, and thanks to all of you.
Good afternoon, everybody.
Take care.